What strategies do you use to avoid making impulsive decisions during trading? So I feel like so many traders fall in the trap of making impulsive trading decisions because they don't think about trading as a career. So for me, one thing that made me stand out, especially with not making such uninformed decisions, especially like taking impulsive traders, I treat my trading like a 9 to 5 job. So I have specific times where I dedicate to sit by the screens, and I normally like to trade between London session and then New York session. So as far as I am seated by the screen, I'm monitoring everything that I'm doing to take a position. I don't consider that impulsive because at that point I'm going through my normal thought process of determining my metrics for taking a position. But it will be impulsive if I know that, let's say, I'm supposed to be trading between the hours of 4 a.m. to, let's say, 12 p.m. And then suddenly I come back by my screen and then, let's say, 3 p.m. I suddenly see something new. I'm like, wow, this looks like something juicy. Let me just take it. Then I'm acting impulsive. So I try to stick to a specific schedule, just like any other employee would be asked to, work from, let's say, 8 to 5. If you choose to work from, let's say, 6, 7, or 8, then it's really up to you. If there should be any, let's say, a sudden unforeseen circumstance or an accident in the workspace, then you put your own self to jeopardy because you chose to work overtime. In that logic, in trading too, then you're supposed to like trade from, let's say, 4 to 12. And then within that space, you are consciously aware of what you're watching. So if you go back and then you're casually out there and then you come back to see a position at, let's say, 3, 4, and you suddenly take it, then you could just be putting yourself in that jeopardy that an employee who's supposed to work within a set of a time frame is choosing to do. So that's what allows me not to continuously like fall in the trap of taking impulsive trades though.
Well, in hindsight, what you're basically saying is you're treating your trading as a business.
Yes, basically.
That's nice.
How do you guys do it though?
For me,
To not fall in impulsive, sudden.
for me is simple. To avoid getting into impulsive trades is following a trading plan. Because if you don't plan, you're bound to fail. The way they normally say, if you fail to plan, you plan to fail.
So would you say like trading plan is like the broader aspect of preventing that errors in trading?
Yeah, it's like my 10 commandment tablet. So I have to follow each rule, and that's like a compass. It guides me into getting into trade. So I'm doing my analysis. I'm choosing what assets to trade before the market opens. In your case, you said London session, where you have a lot of movement. So I have to choose before the market opens. And once I choose 3 or 5, that's all I'm focusing on. If they meet my thresholds and I follow strictly my trading plan, then I get in and I take the shot.
Which assets you mostly use for London sessions?
Which
assets?
Oh, so I normally would trade the pound pairs, the pound crosses.
Mm-hmm.
Yeah, for London session.
Pound
If I'm
USD?
if I'm day trading, I would specifically stick to predominantly watching the pound pairs. But within that same hours, I'm still like looking at my swing trading setups, which would take like a day or two to materialize. But for day trading purpose, I stick to pound USD, pound CAD, pound JPY, and then Euro GBP, just because they move very fast and I can easily make like 50, 70 pips before the day or the morning ends. Yeah.
I think if you use the London session, you don't use with USD. Go for JPY, GPP, JPY, and other crosses, because USD session is closed that time, so you can take a good trades from other crosses.
Yeah, so what makes it interesting is that because logically it's like two economies, which is the UK economy and then the US economy in this sense. Even if the US is sleeping and then there's a vibrant thing going on in the UK, it tends to make pound USD move extremely wild than even the other currency pairs. It normally would happen with the antipodian pairs, Like you'd normally observe that when you're watching, let's say Euro AUD, right, and then or AUD USD and AUD CAD, they like to move in the Asian sessions because the Europe market is silent and dead, so they are active. So it tends to see if there's a negative fundamental or any that comes from their side, then you see their currency extremely selling off. And if it's a positive one, you see them extremely like rallying. So sometimes you would miss your setup that you were looking at to take for, let's say, Euro AUD because you slept and woke up very early in the morning, especially if you live in a country that aligns with like London session. And it happens to me a lot. So I tend to observe that it's only because those European markets are silent, the other cross pair are active. So any trigger, then it allows them. The market tends to not have like a certain direction, especially when two markets are open. That's my observation though, because like things are happening in the US, it's triggering the US side of GBP USD. And things are happening in the UK is also triggering the pound side of GBP USD. So you tend to see, let's say, London session rally up, and then in the afternoon, New York session rally down. So you want to find that sweet spot where one is sleeping, one is active, and you can get one direction for a long time. Yeah.
Do you remember your most successful trade? Which instrument was it? Of course, I do remember my most successful trade was trading NVIDIA stock on an earnings call. Very exciting moment. I love earnings call, especially for tech stocks. And I did a purchase, I did buy. And it was very successful. It was like, I think, 20%. So I made a lot of money and I was very happy, of course.
Is it something you expected?
It's expected since I have been studying NVIDIA for a long time, all the chip strategies. I follow Bitcoin technology, so I know what mining was doing for this kind of stuff. So I did study a lot. It was not a gamble, definitely. It's not that risky. I mean, the account was very big and it was not that big.
I mean the percentage of risk.
You mean where did I position my stop loss?
Yeah.
It was positioned like very below because I just wanted to trade the earnings call. So I wanted to be close at the open of the market.
So I think he's driving towards you risk like 5% of your account or 10%.
You can't control it on an earnings call.
Okay.
Because if the gap is too big, you can't control it, even though you position a stop loss.
Yeah.
So it's more risky.
How has your approach to learning and improving as a trader evolved over the years? My approach initially started with just looking at technical indicators. And at the very beginning, that's what really attracted me to it, because you backtest, you see all these perfect entry levels, you see all the take profit levels. And then later on, I discovered a lot of the indicators were lagging indicators, so they were not really suited for my kind of strategy. So I then later decided to mix the technical analysis and looking at fundamental analysis, because my background is news. So fundamental analysis is really like my cup of coffee. So I incorporated fundamental analysis and, of course, looking at sentiment, the court report, for example. Combining those three is like the proverbial story of the three-legged stool. So the three have to balance in order for me to get into the trade. And I always say, my trade has to tell a story. So if I am buying a currency pair, I have to tell a story about why I'm buying it. And so my evolving is acquiring more knowledge, keep learning about the market, and borrowing from the different strategies from people around me, people I look up to, and I'll just borrow something small from here, something small from another place, combining all that fits to my trading profile.
So which is your best indicator to take a new trade? Your most favorite indicator for trade?
Well, there are a couple of them. I will say at the moment I look at, volume. I'm really, really keen on volume, because once you have volume, then it can give me an idea of momentum, because there are times when you're trading something that has no volume, so you don't have a lot of buyers or sellers or participants in that particular asset class. And so getting in there will eventually just lead me into just bouncing up and down. You're not really having a trend. And so I pretty much look at volume. as one of my favorite indicators.
Yes, volume is a most important indicator for trading.
Yeah. Oh, so you agree with me?
Yes, I
What do
also.
you guys think?
Yes.
Yeah, volume
I love
is-
volume.
It's like our oxygen in trading.
Oh, I like
And
that.
for the process, I think is the ABL strategy I have just made up. Is the always be learning strategy.
Can I borrow that?
Of course.
ABL. All right, great.
How has your trading strategy evolved over the years, and what lessons did you learn from these changes? I think it changes by applying, testing many things. Like I'm testing some indicators I find working of them, and some others not working. And when I find the working one, I keep testing them over many charts, like many currencies, many indices. And when I find a one working well, I keep testing it on many time frames. So maybe one of them working on a daily time frame and other one not working on daily. So I keep testing them until I find the best one working on most of long frames. That was the best thing that have changed my strategy over the years. And of course, the main thing for me was adding my favorite indicator, ATR, the average true range.
Oof, I love it.
Yeah, it was my best risk management strategy ever, and it keeps me growing my account gradually without risking many of my account. That's it.
Oh, you talked about, back testing. Do you have your own rule of thumb when you're back testing using an indicator? Like how long do you go back or try out? 1 month, 2 months?
No. Normally I test for like 3 years.
Oh, 3 years.
Yeah. I have to see what happened before. So 1 month or 2 months, maybe there is a news or something happened in previous 2 months. So it's not enough for me. I need to see a long period. So usually I do 3 years back testing.
So what determines if an indicator is not good for you or is good?
First thing is lagging. Because I saw many indicators lagging and repainted indicators. So
Like 90% of indicators in the market repaint and lag.
Lagging indicators.
yeah. I use some tools that can replay the charts. So when I replay the chart, I can see what indicators gives me as the actual moment. So I keep seeing this for the previous 3 years, and I can see if it's working or not.
What's one habit which sets you for a success trading day that you wouldn't change? Proper money management is most important other than any indicators and any strategies to use. One thing, if I use the proper money management, so I can win all the tradings and all the trade strategies. I do trades flipping the coins.
Nice.
10 trades and use only price action, use only the money management, 1:3. So 7 trades are negative, 6 trades are negative, but my whole trades are in profit. So money management and risk reward ratio is the most important for trading.
Totally agree.
Yeah.
So what if the last 3 trades went into profit, but let's say 1:1?
No, if you use the money management or risk reward, you can go for the 1:3 or 4 or 5. If you prefer the 1:1.
I mean, with the coin tossing, like you said, I'm just giving an example. That what if the 7 straight stop loss, but the last 3 that went well, they did not reach the targeted profits, let's say 1:3, but rather reach 1:1 and then reverse back to a loss. Would you still?
No, then prefer for 1:3 or 1:4, because if you 1:1, then that was not is working.
I get you. I'm getting a question. And for me, his style is... I think it fits your profile. I've done that several times. I find it a bit tricky because if you do if you lose, like you said, the first 7, and then you win the last 3, but your risk to reward ratio is still 1-to-1, and then the
last trade
then
goes
it
down.
reverses.
Then
You're still in a loss. And what I personally do is incorporate what he's saying, the risk reward ratio, plus position sizing. Risk management for me is one of the biggest lessons in trading. So position sizing to avoid over leveraging. And so I look at the size of the account and decide what percentage am I risking in that account. And then now I can go to the next step, which is risk to reward ratio. So if it is 1-to-3, 1-to-5, more often than not is more than actually 1-to-5, because I'm a swing trader. So I'm going for the big swings. So sometimes it can be 1-to-even 10. So the reward is much more in that sense. But
1-to-10 ratio.
sometimes it can go 1-to-10, but that is holding a trade for even more than a month at times.
So you are saying that you can determine that, let's say for a position I want to take 5% risk, but your trading setup you're looking at 1:5 means that 5% for 25%.
Exactly.